Hey Mickey, I'm I'm live on the background, so just bear with me for a second here.
Okay.
Okay. Hey Mickey, I'm live on the background, so just we'll get rid of that, and now we'll go here. Insert into post. Okay, Mickey, thanks a lot for giving me a second there to get everything rolling. We are live now. I'm Allan Labucan. I'm the founder of the Allan Reports. And I've got a special guest today, Mickey Fulp, the mercenary geologist, is joining us today on the phone. Thanks for joining us, Mickey.
It's my pleasure, Allan. Thanks for having me.
I got a bunch of questions for you, but before we get started, Mickey, one of the new routines of my show is I've got a couple new sponsors for the website. One's Wolfden Resources. They're exploring for high-grade nickel and copper in Manitoba, just by Snow Lake there, and have hit some very nice grades in their early drilling. Are you following that one, Mickey?
Not specifically, but I certainly know about that part of Manitoba, and I have to say it's one of the most endowed parts of Canada, and I think the potential there would be quite good.
Yeah, what's interesting about this project, Mickey, is the property had been drilled years ago by Inco, I believe it was, and back in the 50s. And for some reason, it had sat there. They basically just drilled into the main zone. But now it looks like from the early drilling of Wolfden that they've gone through the main zone and actually hit a lower zone that looks like it's leading them to the feeder. So they're now getting ready to drill on ice and test the extension of the lower zone, as well as chase that feeder system.
That sounds pretty interesting to me and fairly prospective.
And only a $5.5 million market cap.
Well, that's not unusual in this day and age.
You got that right. The other sponsor, it has a bit bigger of a market cap. It's Premier Gold. They are very active in high-grade gold in Red Lake. Got some great projects down there in Nevada, and now have a project in construction up near Beardsmore, the Trans-Canada Highway. Are you following Premier Gold?
Again, not specifically, but I took a look at their website, and from my days in working in Nevada as an exploration geologist, I am certainly familiar with the two properties that they have there. What better place in the world to build a gold mine than Nevada?
That's for sure. And I don't know if you're aware, but Ewan Downey runs that company, and Ewan's got a pretty good track record over the years.
Well, he certainly does, and yes, I was aware of that.
Okay, good. Well, thanks for that part there, Mickey. I always like to hear the guest's opinion of my sponsors. It's not one of those situations where just anybody can be a website sponsor. Mickey, you do the same thing, so I like to get others' opinions as well.
Well, always. We need to talk amongst ourselves all the time.
There you go. Well, Mickey and I have been running into each other at various different conferences for a long time now. And one question I've wanted to ask you for years, Mickey, why mercenary geologist? How did you come about that name?
I'm not sure exactly when that thought went through my pea brain, but it's probably one of the best things I ever did. And the basis for it is that all geologists are mercenary. None of us really have real jobs. We generally go from contract to contract, project to project, and a mercenary is someone for hire, and most geologists are for hire, and I just the one that coined the name and trademarked it.
Well, I actually thought it might be one of my good friends who passed away, unfortunately, at a very young age in his 50s, was someone I worked with in the mining business for a long time. His name was Scott Weeks. You know Scott.
I know Scott. Yeah, I knew Scott well.
Yeah,
sure.
and one thing that really early when we started working together, he used to say to me, you know, it's our job to kill these things fast, make them live or make them die. And
Well,
I thought that was how you got the mercenary part.
well, that is our job. In fact, I would probably say that you and I first met through Scott Weeks, probably about 10 years ago or so.
That's right.
And Scott was exactly right. You need to drill to kill, because very few of these projects will reach the ultimate success of making a mine, and even fewer of those will make a profitable mine. So in the exploration play, drilling to kill is the best modus operandi, so you can move on to the next one that has potential.
He sure was a great guy, Scott, Mickey?
Yep.
Yeah, he was
missed.
Very much so, especially by me. We worked really tight for a long time, and I grew up in the business with Scott, and we were mentored by Bob Darney as well, and he's since passed as well.
Well, one of the first companies I ever covered when I became an analyst in 2007, and I run a sponsor model too, was Red Star Gold, and I really covered them for their potential in Nevada, and we made good profits on that, and then and moved on, as we always try to do.
Yeah, that was a good situation when we were down there. We sold the project to the North Bullfrog project, which basically funded the company for about 3 years or so.
Right, and that project continues to advance.
Right, with Corvus Gold.
Yep.
Yeah. So, Mickey, what we'll do here is, because you're on the phone, I'm going to screen share your website, because I think that's the hub where we can get a gist of all your thoughts and what you're working on. So I'm just going to bring you. Oops, brought the wrong screen share up. I'm going to bring your website up here, and we'll get started. Mickey, while I'm doing that, why don't you go into a little bit about what your website and your website and your ability for people to sign up for free to get your work?
Well, as you mentioned, I do run a free subscription service. The website is mercenarygeologist.com.
And I got it up there on the web. It's on. The viewers are now looking at your website, Mickey.
Okay. And on the first page, you'll see my mugshot, and right below that is free subscription. Click here, and you go there, and you give us a name, and we don't even care if it's a real name, but you've got to give us a working email address, and then you get all my products immediately after they're posted. The advantage to becoming a free subscriber is that you get the stock picks. The stock picks are restricted for a period of time to subscribers only.
And you get that by email, right?
Yes. As soon as, if you're a subscriber, as soon as it goes out to everybody at the same time, and we generally try to put those products out after market. Those are called mercenary alerts, and sometimes it behooves people to move fairly quickly on those, because we try to move those or put those out when we think there's catalyst pending or catalysts that have just happened that will cause a stock to go up.
Sorry, Mickey, go ahead.
Yeah, we also publish more general series of mercenary musings, actually called Monday Morning Musings from Mickey the Mercenary Geologist, and those deal with a variety of things: commodities, supply demand fundamentals, macroeconomics, things such as libertarianism, my philosophies about how to trade. We have a series called A Primer for the Lay Investor, which is up to 10 or 12 musings now that give the trading methodology, how we operate, and how we try to make money in the market. We also run a couple of other products, mercenary.
Mickey, before you get on those,
yeah,
just
sure.
for my understanding, if I'm a subscriber to your reports and you send me an email, do you then put that email report up at a later date onto your website as well, or is that just for people that get your emails?
It at the same time that our subscribers get the email, it is posted on the website, but you have to become a subscriber to access it from the website.
Oh, okay.
At some point further on, and that can be as long as a month, sometimes it's shorter, but then we release those to the website and the public, but that's a period of time.
So the best way for me to keep up on what Mickey Fulp's doing with the mercenary geologist work is to be on your email list, right?
Absolutely, and we've got 6,300 people on that email list. We also, as I was saying, run a couple other products. We have a very active Twitter feed. We're now up to 52,900 Twitter followers. We tweet on average 3 or 4 times a day on various things that interest me, and that can be the markets, that can be particular
Actually,
stocks.
Mickey, I'm on your Twitter feed, and what the really cool thing, here's someone who's getting your stuff, I'll say about it, is I really enjoy when I can figure out what's happening with earthquakes throughout the world, and also whenever there's something unique, scientific about anything science related, earth sciences, whatever, you keep me up to speed on some of those unique, quirky little things that really make it interesting. I've never responded to you on Twitter, but I did want you to know that, Mickey, because I have been following you on Twitter for probably a year or two.
Well, we're pretty proud of what we do on Twitter, and it's kind of all over the place, as you say. We post every earthquake worldwide that's greater than a magnitude 6.0. We also post regularly about any active volcanoes in the world. We do a lot of science stuff that's of interest to us. A lot of that's earth science related. We talk about the markets. We cover macroeconomics. We cover the sports teams that interest me. You'll see a lot of recent posts about the Denver Broncos.
Yes.
And I'm sitting here in my
and
Vancouver.
your St. Louis Cardinals.
Absolutely. And I'm a libertarian, so we post a lot of libertarian sort of stuff, and we try to bash the Democratic and Republican parties as much as we can. It's right now Trump the Chump and Hillary. Yep. Not fans of either of those two possible presidential candidates. So we're kind of all over the place. We're very freedom and free thinking oriented. We post things such as, especially in my hometown, Albuquerque.
I've seen
when the
those
police get out of hand, we don't give them much leeway.
I've seen those posts as well too, Mickey, and I'm quite shocked. I never thought, I think of Albuquerque as something much different than, rogue cops sort of acting out of line, but you keep me up to speed on that too. I'm quite surprised, actually.
Yeah, well, it's where I live south of Albuquerque, so I'm not really probably involved in it because I don't live in the city, but I live close, and there's been a few things done over the last few years there that is not quite on the up and up, and we always point that out.
Well, if you definitely got to get on that Twitter, if you're following Mickey. It's an interesting one. Mickey, you brought up something, and I think we might as well politics related. And we were recently at a politicky kind of event in Vancouver at the TSX Ventures town hall meeting. I think the two of us kind of led to that room getting a little raucous at the start, but I think you brought up some good points there. I was especially impressed when you were talking, asking questions about the plans that John McCoach was talking about that, sounded all well and good, but then you pointed out the incongruity of what they were pitching. Why don't you tell us what you were thinking there?
Well, there's a couple of things that really bother me, and I've been pounding on this publicly for at least 2 or 3 years now. One of those is the costs of a public company to just maintain a public listing. And they talked extensively about how they were going to reduce the cost, but they're not reducing their own fees, so they're trying to reduce some of the outside consultancy costs, it appears, with it. And meanwhile, they're trying to build their own bureaucracy. So by adding satellite offices in 4 cities, and so the whole white paper that they put out probably a month or so ago looked to me like a proposal to keep their jobs and even expand their own bureaucracy. To me, it's a conflict of interest that a stock exchange is owned by a publicly listed company on a bigger stock exchange, a sister exchange. So the Toronto Venture Exchange is owned by TMX Money, which is listed on the Toronto Stock Exchange. I think that's a conflict of interest, and I've pointed that out. The other thing that's kind of on my top list are the number of zombie miners, the companies without.
Well, Mickey, that was where, I think your questions about the conflict is really became aware when they start talking about the issue of the zombie companies. It's my argument that they are more interested in listings and fees than they are in looking after investors that are investing in public companies on their exchange. We started to pin the guy down and ask him questions about the zombie issue. My point was that I was trying to pin him down on, he was making the case like all the companies met the listing requirements, and I was baffled because I've been looking at John Kaiser's work, and I know John studies stats really closely. So I was baffled with that. So I sorry for interrupting. I kind of wanted to set the stage a little there with that, where you were going.
Well, yeah, I think well, I told McCoach in a meeting, he said, we are removing the companies that do not meet all the listing requirements. And I piped up and said, well, that's just a bald-faced lie, because they're not. Under the rules, they've got 3 or 4 rules to maintain listings, and the main ones being you have to have $50,000 in positive working capital, and there's at least 600 last year, and from the work Tony Simon's doing presently, there are going to be more this year who have negative working capitals. And then the other key issue is they are required to do $50,000 worth of exploration work on their properties every year, and a lot of them do not do that. In fact, they will write off a vice president exploration salary and count that as exploration dollars in the ground, and that's ludicrous. And so we've pushed them about this, and I have to say that I think that McCoach getting up there and taking the heat, I thought he did very well, and I applaud their reach out to the community in 4 cities across Canada. I don't think that would have happened a year ago. So all we need to do is keep the pressure on. We've got their
Well, you know,
attention
Mickey,
now. Yep.
you're much more of a gentleman than I am when it comes to when the gloves get dropped. I'm much more of a ex-hockey player, and my feeling is about it. You know, so what? You guys get paid all kinds of money. You came out here, you took your punishment for about an hour and a half. You didn't really
Yep.
answer any things. You told us, gave us your marketing pitch. There's a serious problem here. We used to be the leader of the world in venture capital. We're no longer that, and I think it's a joke for them to sort of placate us with, well, you guys are so great out here. Well, yeah, but we're not that great anymore because of the system. And I think why it's been highlighted so much, there was sort of an excuse making of, well, we're in a tough market. You and I, Mickey, were both through the 1990s, especially the late 1990s. You know what a tough market is. There wasn't nearly this kind of money sloshing around in the background. There was no Ross Beatty's being a billionaires, Juicer's being a billionaires. Maybe at that time Friedland was. There was nowhere near the kind of wealth that was created from 2001 to 2011. There was not that in the background in the late 1990s. Yet we were still able to raise money. We were still able to do exploration. The serious companies were still able to survive. Look at where we are now. Yeah, it's a tough market, but these companies can hardly raise enough money to keep up with the fees and everything to stay public. That is ludicrous.
Well, I lived through that as a consulting geologist, and at this stage, I don't think this bear market is nearly as deep as that one. There were very few companies still active in mineral exploration during that period of time. It seems to me that the strong, the best companies, although their market caps are way down, but they still seem to have the ability to finance here.
Yep.
You pointed out the Ross Beatties of the world now include a lot more people in that.
Yep.
The smart money, I think, is positioning itself for the inevitable downturn or upturn. Bear markets don't last forever, and neither do bull markets. So at some point, this is going to turn around. The question that I have: will the Toronto Venture Exchange still be around in a viable form when it does turn around? And that's my real concern. And unless they make some changes, I think this market could just go away. You know, I'm an American, and I saw the penny stock exchanges.
All those little Spokane
and
places, all
Salt Lake and Spokane. I saw those go away in the middle part of my career, and now we only have the bulletin board in the U.S., and that's not a viable option for the Canadian juniors. There are real problems with that exchange. There's not even really an exchange; it's over-the-counter trading, and so whatever we do, I think we need to make some changes in the Toronto Venture Exchange in the short term. Otherwise, it's not going to survive, and I'm not convinced that there can be something else that replaces it in the public venture capital market.
Well, that's, from a guy who's from Vancouver and grew up with all the goods and bads of the Vancouver Stock Exchange. It's part of the fabric of who I was growing up. I remember going on field trips as a kid, a 13-year-old kid, to the floor of the Vancouver Stock Exchange. I was a numbers kid, and it blew my mind. I thought I was in heaven, so I kind of lamenting the old VSE. And when we had control of the market here in Vancouver, we were the capital of the world center of venture capital. We're not that anymore, and a lot of that changed when they got control back east.
Yeah, well, it certainly has. And once again, I go back to the fact that it's a publicly listed company and they run the Toronto Venture Exchange to make a profit. My coach told us at the meeting that on average, companies pay $7,500 in fees to the exchange every year. Do the math with about 2,000 companies. That's $15 million in gross revenues, and that goes into the bottom line of the TMX group money group.
But Mickey, that's not all they get from each company.
I'm not sure.
They've got all you pay a fee for all kind every time you file something.
Well, yeah, but I think that is the total, and I can't swear that is, but that's an all-inclusive totals, because the amount just to list is considerably less than that for a listing, but they charge you for your liquidity, they charge you for every press release, they charge you for this and that, and I actually got the impression from what my coach said that was the average total fees that a publicly listed company pays.
I'd like to look into that, and that nowhere represents the lawyers you have to talk to.
No, that's a good point, Alan. I don't want to include that. The real costs of running a public company here are the lawyers, the accountants, the auditors, all the other ancillary things. They support an entire consultancy industry here on corporate compliance to keep your listing on the exchange, to file with securities commissions, to appease IROC. So, yeah, that's a small drop in the bucket, but those, from the way I understand it, are the direct fees that actually go into the Toronto's Venture Exchange.
Okay, I got it. Well, I don't know if we're going to be able to change much with the exchange, Mickey. Onto more positive things. I'm looking at your website there, and just under your handsome picture, you have a chart of gold. And I'm noticing the really nice cup formation that has been going on for the last 6 months. And today we got a little bit of a parabolic move after it, kind of got the right side of the cup up to 1200. I thought it was going to go sideways for a little bit of time because it had been a former sort of resistance, but it blew right through there today, and hopefully it becomes the new support.
Well, I was quite surprised when I got up this morning and saw that it had blown through the resistance at 1200, because it touched that on Tuesday, if memory serves, and briefly touched 1200 and then backed off, but it blew right through it today. I think a lot of that can be directly attributed to the fact that the U.S. dollar has dropped almost over 4% over the last week.
No, almost, Mickey, it's dropped from 99, almost 100, 99, let's say 99.75. It's now what, 95 and a bit?
Yeah, 95. I got 95.60 right now on my Kcast on my computers. So it's dropped a little bit more than 4 percentage points
in a short period of time.
And so if you do the math, I've got gold at 1245 right now. 4% of that would be about $50. This latest move really has accounted for the weakness in the U.S. dollar for the most part.
And it's now trading down in a pattern that looks to me like it had tested on the index I'm talking about. It had tested that 94 4 or 5 times last year. It looks like it's on a collision course to go right through that.
Well, I don't know what to predict about that. When it comes to the dollar index, I just kind of take it as it goes. It's been the only fiat currency in the world that anybody wants to own. That makes sense to me. As a good old American, it is the world's reserve currency. And when times get tough, especially in what used to be called the third world, now called emerging market countries, with their very weak currencies, people flee to the dollar. if it actually breaches resistance on the downtick, and
Yeah,
it
but
is
Mickey,
around.
that was before the U.S. had 19 trillion in debt, which is about 100 and some percent of the of GDP.
Yeah, well, explain to me then, Alan, how it reached 100 here. It's hit
I know,
103
yeah.
times over the last year.
I
So,
don't have, I don't
you know,
have that.
the U.S. is at this stage not doing any quantitative easing. Europe has just embarked on a new round. The Japanese have embarked on a new round. So, like it or not, I think the U.S. currency is one of the things you want to be in right now.
I just a couple days ago, I had Eric Coffin on, and he had an interesting chart that I think is relevant to this conversation. He had a chart of all the countries that tried to raise interest rates after the economic crisis, and how it would peak, and then very shortly they were notching them down below where they had gone before. I mean, could you imagine if the most, after all that stimulus, the most that they could bump it is a quarter point? And where do you go when you're at a quarter point is the peak?
Well, and so I will counter that by saying, at least in the U.S., we do not have negative interest rates, which you now have in
Japan.
And you have in Europe, you have in Swiss banks. They actually charge you to store your money there.
Okay, that's
and so from that point of view, you should take a look at a thing I wrote about a year and a half called "If You Keep Your Money with the Banksters, They Are LOL." And I make the case that you should only keep in your bank accounts enough for working capital, and you ought to store the rest of your cash under a mattress or wherever you want it, because the only thing that can happen to it there is it gets devalued. It cannot be confiscated by a government if it's in your own physical possession without getting violent on you.
Right. Well, we can segue into the next thing now that you brought it up. Your writing, musings. I'm going to pull that up on the website there, Mickey. And the first thing, let's go over a couple of these past reports you've done, and then maybe we'll get on to some picks you want to talk about.
Okay.
So on February 8th, you wrote an article called "A Crude Correlation with Canada's Currency." And I've got that up on the screen now. The first chart that you come up with is contributions to 2014 nominal GDP. Why don't you walk us through those charts a little bit, Mickey?
Okay. Glad to do that. So the first chart on the first page shows, and my source is Natural Resources Canada, which is one of your government entities, and we show that that natural resources contribute 20% to Canada's GDP, of which 10% is energy, and most of that energy is from oil exports. So if you look at the second chart, it shows that 28%, and it's so you have 53% in natural resources. If you do the math, 28% of Canada's export revenues come from energy, the most of which is oil and gas, and 97% of that energy goes to the United States. So that tells you right there how dependent the Canadian economy is with natural resource industry, which would include energy sector, the mineral sector, and the forestry product sector. Then we took a look in the third chart.
Makes up, I'm reading the chart, right? It makes up over 53% of the GDP.
Absolutely.
So yeah. It's no wonder the Canadian.
Actually 53% of your export revenue.
Oh, export revenue. Okay.
So the natural resource sector would be 20% of Canadian GDP, and that's quite high for any country. That's a modern first world economy.
Mickey, have you done any work like this on countries like Australia, New Zealand? Would I be seeing something similar to this in those countries?
I'm certain you would, and the Australian dollar, we have not done that. That's something we might consider. But you know, Australia's half a world away, and we really focus in North America
Okay.
for our markets, and because I mean, our economies, in the U.S. and Canada, are so closely linked that. So, and most of my business comes out of Vancouver, although I don't live here. But I do maintain a second office here in Vancouver. So,
I get it. So it makes more sense economically, and we're brothers and sisters. Our two countries. We do all our we most our biggest trade partner is next door. We might, if you're going to look for a currency that's fluctuating based on commodity prices, why not look at Canada?
Well, and that's certainly true. And what we've tried to show in this very short musing, and I think it's all of 600 words long, so it's a quick read, although you got to focus on the charts, is the extreme correlation of West Texas Intermediate crude, which is the North American benchmark for oil,
Okay,
with
because now
the Canadian dollar.
Mickey,
Now what
I've done is I've scrolled down to the charts of the WTI and your correlation coefficient. So that's on the screen now.
Okay, so if you look, we've gone from July 14th, the 1st of July, and on WTI, West Texas Intermediate crude, plotted time versus the price for a barrel of oil. And we picked July, the beginning of July in 2014, because that's when the dollar first went above 80 on the index, and it's not looked back since then. So you can see the falling oil price with for now year and a half or 19 months actually, and with very little respites, a couple of small rallies, but now trading, and this is through the 1st of February, not updated, at something on the order of, geez, it's longer than a 10-year low. And then we started, took 3 periods, and did just a simple correlation of the oil price and the Canadian dollar versus the U.S. dollar, and that's what you see. So in the first chart, it goes from the aforementioned July 1, when the U.S. dollar started to rise in 2014, and it goes to when the bear market for gold first hit, and we define that as starting on October 1st of 2014, and that's when oil was at $91 a barrel, and it never saw that since. So that's a correlation coefficient of 0.84, which is a very strong correlation.
Now you've got 2 charts below that, one a correlation of 8.88 and 1.97. What are those telling us?
Okay, the next chart, we went from October 1st to April 30th of 2015. October 1st, 2014 to April 1st of 2015. Okay. And we picked April 30th of 2015 because that was the last time where the correlation was about the same. So I'll explain that a little bit more. That's correlation of 0.88. So you see a slightly better correlation. But beginning on May 1st of 2015 to February 4th, the correlation is nearly perfect at 0.97.
Oh, okay. So if I'm reading this right, in that 0.84, it looks to me like about 50% or 60, 70%. It was almost right on that line.
Right.
It very rarely went way beyond the line, up or below it. In the 0.88, almost all of it is a gain, and there's a little gap in the middle where it drops below that line. But
so I'm going to interrupt you there and explain that second chart a bit.
Okay.
So if you look when the U.S. dollar went from 0.82 and change to a little bit more than 0.88, there's a secondary trend in there, and we could have gone in and split out some different time periods, but then again, you're still getting this very strong positive correlation, so we chose not to do that.
Despite that's telling me there was a fair bit of volatility in that period, which is why it might also be a little bit off.
Yep, exactly.
Okay, so now either your next one, it's almost entirely on that line. All your data points.
It's nearly perfect for a positive correlation. Perfect would be 1.0, so it's essentially 97% directly correlated as the U.S. or as the price of oil goes down, the Canadian dollar goes down. And it makes sense because your economy is so dependent on oil exports.
Is that a period of when to when? That
would be from May 1 of 2015 to February 4th of this year. So
that's
that
your,
would be, a 9-month period.
So that's your most current 9-month period. The other ones are a bit further back, right?
Correct.
Okay. So in our most current, since 9 months ago, it's almost been 100% correlated, the Canadian dollar to oil.
Yep. And not only does it reflect the dependence of your Canadian currency on crude oil, but it also reminds us of the fact that as your oil export revenues go down, so does the entire Canadian economy, and that's not surprising. I mean, the American economy is suffering because of low oil prices right now. It's more than going to the pump and saying, oh, gas is cheaper now. The conclusion here, as goes oil, so goes the loonie, and so goes the Canadian economy, and until this 1.5 million to 2 million barrels of oil glut goes away, I don't see that the Canadian currency is going to go up very much. I think it's going to continue to remain weak.
Mickey, I pulled up a daily chart of the crude oil for the last year, and it's been a pretty violent chart that needs to create some sort of a bottom. I think we may be within a few bucks of that bottom. Did you write this piece as a contrary play for are you getting bullish on the Canadian dollar? Do you think that oil's overdone on the downside? Is there a big play to your argument there?
Well, I'm hoping. I thought that oil bottomed on, if memory serves, and I'll have the chart in front of me, I think it was January 20th.
Yes, you're right.
It hit 26.
Yeah.
Closed at 26.58, if my memory is correct.
I've got my cursor circling exactly what you're talking about there.
Yeah.
On the chart.
So I thought we were at bottom then. We are testing that today with oil at 26.91. I've seen some very negative reports coming out that says oil can go down to $20. But it can't stay there very long. The world needs oil. We have a current supply glut of oil, basically because everybody in the world, with the exception of Libya, increased their oil production last year.
While everyone is throwing the baby out with the bathwater, Eric had another chart that was quite interesting, and he had a chart up there of oil oil demand after the global economic collapse. Since then, it's been like a chart that starts at the bottom left and ends the year at the top right. It's an unrelenting chart that will never stop in our lifetime and generations' lifetime. So, there is a cost to producing oil, and yeah, there might be an overhang in the market now, but how long before that unrelenting growth in demand eats up everything and we don't find enough?
Well, certainly that's of concern because we've quit drilling now for the most part. The point and Eric's point are very well taken. You know, it was only 3 or 4 years ago the world used 91 million barrels a day. Last year, or right now, we're using 94 million barrels a day. That's well over a 3% increase. With the $100 a barrel oil, there was a lot of over stimulus of production, and so we're producing somewhere around 95.5 million barrels a day right now, and we don't have that demand. Demand growth has slowed down a bit, and it's not going to be that long before demand catches up with supply. We're going to have supply come off, and from that point of view, I think what you were leading into would be, am I looking at oil companies now? Absolutely. I'm a contrarian.
Eric,
this is the time to get into the oil market, or if not right now, you may not be at the bottom, but there's going to be some real bargains out there.
I agree. In fact, Eric and I were saying the same thing on the show just a couple days ago, that they're finally down to prices where I can speculate on them and valuation. So I'm starting to look around at oil deals. In fact, if you have a chance, that the PDAC, they're going to be having a subscriber summit on Saturday, and they have Keith Schaefer, who will have some oil picks. So I might go to that and just to hear some oil picks.
Absolutely. I spent yesterday afternoon at my usual haunt after work with a couple of brokers in town who specialize in oil and gas, and we were trading ideas and picks and looking at where we could deploy some speculative capital into the oil business. The thing about the oil business is different than the mineral business is these companies can go bankrupt. Mineral exploration companies very seldom go bankrupt. But these oil companies all have lines of credit.
Yes.
I think you've got to make sure that you pick companies that have enough cash flow and that they can service their debt and they don't go bankrupt. But there's going to be some great assets coming available from bankrupt companies, and you're going to start seeing some moves made, I think, even by the majors on distressed assets.
Well,
accumulating distressed assets from smaller companies.
I think that, if you're a true contrarian, when assets have clipped off 90% of their value, some of these $20 stocks are trading at less than $1 now. I think you have to be looking now. And so, especially if you got some American dollars, you can buy Canadian assets at dirt cheap prices.
Or you can do as I tongue-in-cheek said at the end of this most recent musing about oil. It's bad for most Canadians, this week loony, but it's not so bad for Americans who want to go shopping on Robson Street.
Well, we were pretty good at shopping down in Arizona and some of those places for real estate after 2011. A lot of smart Canadian money went down there, so you better get up here and do some shopping, Mickey.
Absolutely. Well, I'm here now, and I plan on taking a little trip along Robson on Saturday along with my girlfriend and see what kind of values we can find.
Great. Well, Mickey, now I'm back at your website, and I see you've got, it looks like 2 articles related to uranium. The changing world of uranium mining, and I think the path to enrichment. Is that also related to uranium?
It most certainly is.
So what I'm going to do is, I really like the sound of the changing world of uranium mining. So I'm going to pull that up on the screen right now, Mickey.
Okay.
And let's tell us the story, why things are changing.
Well, in this musing, which is once again a very short thing, 700 or 800 words with a bunch of charts in it, we show how the sources of uranium, of mined uranium, have changed from 2004 when the price of U3O8 was still $10 a pound to 2009, a 5-year period, to 2014.
Okay, hold on, Mickey. So I can see here, I've got the uranium production for 2004, the pie chart. 29% is coming from Canada, 22% from Australia, 9% from Kazakhstan, 8 from Niger, 8 from Russia, Namibia 8, Uzbekistan, I think it is, or Uzbekistan, 5%.
Uzbekistan.
Okay.
Uzbekistan, yeah.
US 2, Ukraine 2, South Africa 2, and all others are 5. Now you say there's another chart of 2009. I've got that up on the screen now.
Okay. So what we showed here was in 2004, Canada and Australia contributed 51% of mined uranium in the world, and 5 of the 10 largest mines were in Canada and Australia. In 2009, things really started to change. Kazakhstan was coming big time.
Wow,
with
they moved
recovery at the expense of well, I didn't say that right. Not really at the expense of Canada and Australia, but the growth in worldwide demand was up 26%. But you see the relative downfall of Canada and Australia.
Yes.
Most of that supplied by Kazakhstan.
And that went from 8% in 5 years to 28% in 5 years. You know, this is an important fact that we saw in other commodities as well, especially in gold in the 90s, when you could have done a similar chart of how much production of gold came from South Africa and how it's changed in the last 10 years or so. This is a pretty shocking. I was not aware that it was this significant, Mickey.
Well, it is, and it continues to be. You also notice, if we're still, I assume you're still looking at the top 10 uranium mines in 2009, you'll notice that we have 3 of those highlighted: McArthur River, Olympic Dam, and Somer in Niger. And those are the only 3 of the 10 largest mines in the world that appear on all 3 lists over a 10-year period. And that's also important too. But if you look, the world total continues to increase. If we go in and look at 2014, the world output continues to increase significantly, but now we have Kazakhstan at 41%, and Canada and Australia continuing to drop. Canada's production dropped 11% in 5 years. Australian production was down 37% over 5 years. But demand continued to go up significantly, and it has been replaced strictly by the increase in Kazakhstan's uranium, which is in situ recovered and is very low-cost production. The real concern here is that if you look in 2014, the top 10 countries in the world in uranium production, fully 6 of those countries you would consider as unstable, corrupt governments and or unfriendly to the West. And that would be Kazakhstan, which is still pretty much a Russian satellite, Niger, which has extreme resource nationalism and ongoing terrorism events at their mines, Russia, Putin's no friend of the West, Uzbekistan, again, a former Soviet
I see where you're going with this, Mickey. You're making the same case as they make with safe oil.
Yep. And China and Ukraine. So 6 of the 10, and that's 61% of the world's production comes from countries that are unstable, corrupt, and or unfriendly to the Western world. And I find that of concern.
You know, another thing I've noticed from your 2 charts, even from 2009 to 2014, is how those three mines have all risen to the top. MacArthur River, Olympic Dam, and Somare. And I know for sure a couple are.
So the point being that the world's largest mines, the world's good and largest mines, continue to produce. But by 2014, if you look at the world's 10 largest mines, the majority of those, and I'm pulling it up right now, bear with me, 5 of those are now in Kazakhstan.
Right. Yes, I see that. Yeah.
And there were no mines in the top 10 from Kazakhstan in 2004.
There was 2 in 2000. There was 2 in 2009.
Yep, and now 3.
Wow.
And part of that has to do with ISR production, in situ recovery. The world is increasingly dependent on in situ recovery now. If you look at the final chart.
Hey, Mickey, is that anything like when they inject steam into oil? How do they?
Yeah, it's very similar. You develop a minefield and you have injection wells and recovery wells. In the case of uranium, it's very easily oxidized, so you inject generally baking soda or equivalent to club soda. You inject that down the hole and you recover that. You dissolve the uranium and recover it. In Kazakhstan, they still use dilute sulfuric acid to do that. So the country has a very strong advantage because they use acidic solutions. It's very safe. We used to do that in the United States. Now it's outlawed. Why? I don't really know. We do it for copper. Why we can't do it for uranium, I don't really know.
It's the bugaboo.
Except for Russia and Kazakhstan, the world does not use dilute sulfuric acid to leach uranium anymore. The other advantage that Kazakhstan has is that they devalued their currency by 26% last year, and the currency has continued to weaken against the U.S. dollar. So uranium is sold worldwide in U.S. dollars, so their costs have gone down. Very similar to what's happened in the gold business in Canada and Australia. You're at an advantage because your costs have gone down relative to the U.S.
So it sounds to me like you're making a case that, you want to be looking for projects in more Western country safe jurisdictions. Do you have some picks that you could share with us in the uranium space that you're bullish on, Mickey?
Yeah, well, I've been involved in uranium space for quite some time, mainly through domestic U.S. producers. And so within the last year, I have covered 2 U.S. producers, Uranium Energy Corp, which has cut back its production significantly, but is standing by to ramp that up once uranium price goes up again, which is inevitable with 66 reactors in construction, another 158 in the planning stages worldwide. And then the other company I've covered recently is Energy Fuels, also a U.S.-based producer, and they produce both conventional uranium, underground mining, and ISR production. So they're very well set for the future.
Now, Mickey, I know you follow Saskatchewan closely. I noticed, is it because you're so close to those other ones that you're focusing, and because you know the jurisdictions and you know the deposits well, or are you not following anything up in Saskatchewan? Everybody who's bullish on uranium seems to have something in Saskatchewan.
Yeah, so I've got, I am a significant shareholder of Canalaska Uranium.
Yeah.
Which is a prospect generator in the Athabasca Basin. I covered them for most of last year, and so of all the exploration plays in in Canada's Athabasca Basin, and I dare say that they are by far the world's best deposits, although they're generally fairly expensive to mine. I like Canalaska.
Okay. Well, let's go now to your 20-year record of gold. We're going to wrap it up on gold. Mickey, considering we had that big spike and everything's done so well, you put this out on January 4th, 2016. So let's see how prescient you were now that we've had seen what's happened since then. I've noted my bullishness on gold starting the year was primarily because I had been looking for a bottom in gold for a long time. I thought we got it back in I think it was August, September. We had a little bit of a rally there, and I thought maybe that was the bottom, but then Draghi came in and smacked us around. We got some more bottom creation, but by the end of the year, the last couple trading days, I saw some positive action, and I'm going, okay, is this the indicator of where the first 5 days in January are going to go based on the January effect? And certainly we got the first 5 days looked real good. So I put out a report not that long after talking about how I had saw the US stock market have one of the worst starts to the month, while gold had one of the best. And I had said, well, this means that, usually gold's going to do well in January and subsequently well throughout the year, and the opposite for US stocks. And that seemed to come out fairly good. What were you talking about in early January, Mickey?
Well, we look back since for a 20-year period starting in 1996 through 2015, and we plotted a series of charts, and it's probably it's a little too complicated to go through efficiently chart by chart here. Okay. So I'll just give somewhat of a summation.
Perfect.
We normalize those charts for January 1st of every year on a yearly basis, the gold price, and we determined from that 20-year record what constituted what we defined as a bear market for gold or a bull market for gold. Simply, if the price opened on January 1st lower than it closed at on December 31st, we defined that as a bull market, and vice versa. Then we started working through specific dates to see how gold behaves. So we started June 1, went to October 31, and as everybody probably knows, the price of gold goes down in July and August, and it rises in October, and there's very good reasons for that. July and August is generally the summer doldrums, and you get a rally post-Labor Day continuing into October based on the wedding holiday or the Indian holiday and wedding seasons. Then we looked at a period from October or November 1 to January 31 and showed the way that you get a pre-Christmas rise, a little bit of some doldrums, and then this phenomenal rise in either bull or bear markets in January. We combined that all into one composite trading chart from June 1 to January 31 on a trading day composite over 20 years, and showed unequivocally that you should buy gold in July and August and sell it at the end of January. And if you did that every year, you would make somewhere between 7 and 8% on your money on an annualized basis.
Okay, so now let's say that's a good indicator for most years. We're now 11 days into February, and we've got a more spike. Do you think that this year could be different? I think that this year we could end up, based on the January, 20 to 25% higher by the end of the year. What are these charts telling you, Mickey?
Well, I'll be honest with you, we haven't done a post-January 31 treatment under this scenario. We're going to mess around with that a little bit. I don't know what it's going to show us. If it shows us something compelling, we will come out with another musing. But the early returns this year have been quite significant.
Absolutely.
And we are all very hopeful this is going to be a very good bull year for gold.
Now, in that kind of scenario, Mickey, what are some gold stocks you're following?
I am not following any gold stocks specifically at this point. I own some gold stocks. Once again, kind of like oil, I've been on the sidelines for a while. You know, I really lightened my load in gold stocks in 2011. And I decided that they were overbought, and I quit covering most gold stocks. I've had a couple since then that I thought could run, but I saw an overbought situation in gold, especially in the stock market in early January of 2011, and luckily I took profits and got out of the gold mining stocks, the gold exploration stocks, for a significant part of those early in 2011. Now that we've come back to reality in the gold price, and I thought 1900 was a ridiculous price for gold, I'm very comfortable where gold is right now. The gold miners have started to turn around. We've done some extensive work on gold miners and exploration and development companies over the last year. One called The Real Cost of Mining Gold, which looked at the majors. We did one called The Real Value of Gold in the Ground, which looked at exploration and development companies and possible takeouts. And once those companies have gotten their ships in order and sailing a straight course again, it may be time to take a look at gold companies again.
Well, you know, on that note, Mickey, you kind of shown that your timing was good in 2011, and I think when you're getting ready to get back in and pick again, I'm hopeful that some of my readers have sign up for your report as well, because I know you do your homework and you know, you research these companies, you go do property visits on them. You're a geo. And so, you know, I really wanted to get you on here today to talk about what you're working on lately and what you do with your site, as well as where you think things are going, but also to get my my readers to know that they can sign up for your stuff for free, and they should.
Well, I appreciate the kind words there, and I should also mention to my subscribers that they should sign up for your newsletter too, because I followed your work, and I know you do good work and strong due diligence, which is very important if you're going to speculate in these junior stocks. And so I will give a little plug here at the end. And this interview, as all my interviews, go up on mercenarygeologist.fm, and that's a 24/7 streaming audio on the internet of various recent interviews I've done. And so people might want to check that out too, and we'll have this interview up as soon as you get it to us.
Yeah, and there it is right on your website. You've got some key point interviews, musings. All your stuff is easy to find there. So definitely hopefully we'll get some people tuning in on your website to this interview as well, Mickey.
Well, I hope so, and I hope we get some cross-pollination. Let me say that again.
Yeah.
Some cross-pollination here, Allan, and I really appreciate the opportunity to come on and talk to you.
I'm really glad you did, Mickey, and I told you a couple days ago that I'm working on getting a roster of guests like such as yourself to come on a regular basis, and I'd love to have you in the cycle there.
Well, I'd love to do that, Allan.
Well, I'll be definitely getting in touch with you again, Mickey.
All right.
Before you don't go off the line there, I'm just gonna I'm just going to wrap things up here, and then we can talk for a bit after the show. Mickey, I just got to get off the screen share here. So thank you very much, folks, for joining us today. As always, my reports are for information purposes only. It's important for you to do your homework and speak with your financial advisors before making any investment decisions. Again want to thank our guest, Mickey Fulp. Thanks a lot, Mickey, for coming on. And we're going to get you on again for sure very soon.
Thanks a lot, Allan.
Okay, everybody have a great day, and we will talk to you soon.